Good morning, everybody, and welcome to the Seiler Wealth Management video blog. It is Wednesday, November 4th, and I'm glad you're joining me this morning. And I'm going to go dig in the bag of questions because I get this question quite a bit, and I've been kind of holding off on explaining to you what it is, but I think it's important to know. And a lot of people hear the term or try to use the term, don't understand what it is. It's PE ratio, and you will see it written and noted as P/E ratio. It's also called price to earnings ratio. People also say call it's multiple. And a PE ratio is a number that is derived by taking the price of a stock, dividing it by the earnings per share, and coming up with a factor, a number. Okay, so let me just take one step back. When a company makes $1 million, they don't usually calculate, oh yeah, they made $1 million. What they do is they take the number of shares outstanding, divide that $1 million, and it'll come up, well, they earned 50 cents per share. So that's how you do it. You take the price and the earnings per share, it's $2 earnings per share, and then you come up with a factor. Now, that number can mean many things. It can mean a stock is overvalued, undervalued, fairly valued. But what we look at, and here's what I caution everybody, is that the PE ratios vary based on industry group. And I'm going to give you an example. The S&P 500, that average PE ratio in the S&P 500, we're talking the median for average, 15-16. That means the S&P 500, the 500 stocks, all together, their PE ratio, they trade 15 to 16 times earnings, multiple of 15 or 16, 15 to 16 PE. That's where you'll hear that described. So your thought process would be a higher number means that it's probably a little bit pricey or a little overvalued. A lower number, let's say 12, meaning it's a little undervalued. However, when you look at PE ratios, I'm not looking at today's PE ratio. We really don't care about today because we don't buy a stock for today. We're buying a stock for 12 months from now or 6 months from now or sometime in the future, okay? Most of us aren't day traders, and 100% of us shouldn't be day traders, okay? That's a losing proposition. So if you're out there trying to day trade your account, I'm confident you're losing. And if you can prove to me otherwise, I will gladly bring you on this little program and share your knowledge, okay? So what you look at, let's say, like for example, today's PE ratio in the S&P 500 is, I see different versions of it, but 21, 22. So by most standards, we're a little bit overpriced today. However, when you go forward and look for the next 12 months, we're back down to that 16, 17 range. So by no means is the S&P 500 cheap. I mean, it was cheap when it was a PE of 13, 14. You had a little bit of room there. So PE ratios are critical. However, I want to just explain to you that each industry group has their own average PE. What I'm telling you is these are the average PE for the 500 stocks. Bank stocks, the big ones, the JP Morgans, the Citigroups, the Wells Fargos, they trade at a little bit of a discount to the S&P 500. Okay, so they may trade at 12, 13. Wells Fargo's trading at 13 current PE. Okay, which means probably going forward, they're probably trading at 10 or 11 times forward earnings, and that's what we look at. This is very confusing, folks, and I will go into it deeper if you'd like. Biotech stocks could trade at 100 PE because they barely have, if any, earnings at all. And some biotech stocks have no earnings because they're research and development. Okay, utility stocks don't have a lot of growth. They're really just a dividend yielder. There's not a lot of new power being generated in utility stocks. It's just, this is what it is. You have your customer base and you're making money on it and you're paying out a dividend. So utility stocks typically trade single digits, 5, 6 PE or 5 or 6 multiple. The higher the PE, the more the stock has to prove to you that it's worth that higher PE. Because what a PE is telling you is, for example, I'm going to give you some numbers here. I wrote them down. A stock price of $43 divided by earnings of $2.40 per share That gives you a PE of 17.92. I'm not telling you what the company is, so we don't know, okay? But 17.92 would be phenomenal if it's a biotech stock, but would be pricey if it's a big financial. So again, there's a lot going on, but what that 17.92 PE means also that this stock has to earn $2.40 a share for the next 17 years to pay for one share of stock. Okay? Think about it. We had a $43 share of stock. The company earned $2.40. You make that division, and you have 17.92 PE ratio. So if you earn that $2.40, 17.92 years, if you do the reverse math, you're at $43. So who wants to hold a stock 17 years to earn that one share? That's what their thinking is. And that's why when companies, I'm getting to somewhere here, and that's why when companies miss their earnings or disappoint their earnings, that just throws a monkey wrench in the whole stock price, because now they're all of a sudden, oh, geez, we were expecting $2.40 a share. They're only going to come in at $2.20 a share. That's going to knock their multiple higher and probably make that stock a little bit overpriced. What's the best way? Well, there's two ways to get that PE lower. So if you have a median PE in the S&P 500 of 16, what's the best way to get that PE lower? The best way? Well, the best way is to have great earnings. Beat street expectation so that PE drops down to 14 or 15. Now that stock may be undervalued. That's the best way to lower your PE ratio. There's another way to lower your PE ratio, which is not so great, but that's the price of the stock drop. So you have a stock drop from 20 to 15, that PE ratio is going to drop 25%. It drops the same percentage as the price of the stock would. Now, doesn't mean it's undervalued at that point, because you have to look at what's going on with the earnings. If they're really going to fall out of bed and just be absolutely horrendous, it probably isn't worth that much. So that investors are going to say, wait a minute, we have no growth here, so the PE on this stock should be 10. There's no growth. Okay, if there's hyper growth, then you may be 20. Maybe that's a value. So this is really complicated, but I wanted to bring it up to you, and I'll talk more about PE ratios. There's another component to that. It's called the PEG ratio, which is price earnings to growth, and I'll address that next week. It's very important as well. But I just wanted you to know this. When you hear somebody said, Facebook, which they report today, they're trading at a multiple of 22. Well, let's see what that means, okay? 22 for a Facebook is probably really good because they're growing their company rapidly. The slower you grow your company, the lower your PE should be, and that's what you've earned. Apple used to have a PE in the hundreds, and now it's trading in 14 because their earnings are so good, but they're still a growth company. So Apple still represents a value, which means, let's go back now to the S&P 500, which is trading currently at 21.22, and Apple's currently at 14.15, so it's trading at a discount to the S&P 500. But again, is it current PE or forward PE? That's what we look at. But I wanted to bring this to your attention. I know it's a lot of information. Thank you very much. Share my video. If you have any more questions, contact me, message me on Facebook. You can also email me, stockdr@stockdr.com. I'm Lee Seiler. Thanks for joining the Seiler Wealth Management video blog, and I'll see you next week. Have a great rest of the week.